Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Isabel Barrow, Director of Financial Planning at Edelman, to discuss prioritizing student loan repayment and what to consider when purchasing a home in today's environment. Isabel, it's great to have you with us. Welcome to Trade Talks.
Thanks so much for having me, Jill.
You got it. How should student loan repayment be prioritized in terms of managing debt? And what if you can't repay? What are your options?
Yeah, well, we consider certain types of debts to be destructive, while others might be constructive toward your overall financial plan. Credit card debt, for example, can often be destructive as it allows us to purchase impulsively money we might not have. But on the flip side, your home, your car, student loan debt, well, that's far more purposeful than the vacation you might still be trying to pay off 6 months later. So typically, your focus should be first on paying off credit card debts if you have them, personal loans if you have them, and then keeping up with your student loan payments and other debt payments. You don't have to pay off your student loan debts early, but doing so might help you if you're thinking about other purchases down the road, like a car or a home, because one thing that a lender is definitely going to look at is your debt to income ratio, and those student loan debt is going to impact that. So now if you are a student loan borrower who is at risk of defaulting on the loan, you need to immediately contact your loan servicer and understand how you can get back on track with those payments. And that might mean debt refinancing, it might mean a loan modification program, it might mean an income-driven replacement plan. So there are options, but you definitely need to get back on track and start making those payments.
Can you give us a quick overview of the state of the housing market as it stands currently? What are the top financial considerations prospective home buyers need to know about making a purchase in the current market?
Okay, so well, first, we came off 2023 with having been in a very strong real estate market. And so there was some speculation, I think, in the industry that the market is due for a pretty big pullback. And we did see that happen maybe to some extent in the beginning of the year, but certainly in some areas more than others, but generally the downward trend just didn't continue through the year. And so what we're seeing with a lot of our clients is that prices are high, mortgage rates are high. It's very likely going to be, for many people, even more expensive to move, even if you're planning on downsizing, than it is just to stay put, in your house. And we do know that very often when people retire, they're moving to downsize, maybe to get to a better climate, to be near family, and they might be selling, the bigger family homes, downsizing to something smaller and what used to be historically cheaper. But with the prices and the rates as high as they are, many retirees are just holding off on doing anything. And of course, that lack of selling is then making the market somewhat frozen up and keeping the prices high. It's just, supply and demand. We have lots of people still looking to buy, maybe even get into their first home, but there aren't enough homes to go around, because if you're a seller, you're not willing to leave your 2-something% mortgage to get into an 8% mortgage on a smaller house that might end up costing you more. There's just not a lot of movement.
Yeah, so you have the competition with the first-time home buyer, as well as people looking to move into a smaller home as they downsize as well. So it's a double whammy. The Federal Reserve indicated in September that it may raise interest rates one more time. How might another rate increase impact home buying decisions? And what about if, in fact, there's a decrease on the horizon?
Yeah, well, the increase, I think, really just prolongs the frozen up market, maybe even makes it worse, because, supply isn't going to be changing, at least quickly. And the demand isn't changing either. So it's just getting more and more expensive with every rate increase to a buyer. I mean, at least those who are planning on using a mortgage. We know that the real estate market overall has just been severely impacted by the lack of new building and the really conservative approach that many home builders and flippers even took after the 2008 housing market correction. So since we know that supply is low across the board right now, if on the flip side, we saw rates start to go down, at some point next year, maybe, this might encourage builders to pick up the pace in new home building. And that, of course, in turn would have a positive impact on the supply, thus keeping prices in check, or maybe even, in some markets, helping to reduce the prices. Plus, we would see those sellers who were on the sidelines and those, low mortgage rates right now that were before unwilling to sell because of the higher rates, maybe start to consider if that move they've been pushing off makes more sense now, or is becoming more affordable in a new lower mortgage rate environment.
Right. And Isabel, our job, this is what you and I do. We look at interest rates. We follow, the economic cycles. It's what we do every day, but not everyone does. So is there ever a right time to make a big purchase? And how can potential home buyers prepare for big ticket purchases?
Well, I think, yes, the right time to make the purchase is when you're ready. When you've set your goal, you've saved for it, you are prepared for the payment, and you're also prepared for the unexpected things that could happen. Meaning you have your debt under control. You've paid off your credit cards, personal loans, you've cleaned up your credit report. Ideally, you've got your debt to income below 36%, meaning, maybe that means you have to buy a cheaper car, or you have to pay off those student loans we talked about. You need to have your emergency fund, at least 6 months of your living expenses in an emergency fund when you're including that new mortgage cost and insurance cost and taxes. You need to have 20% down, ideally no more, no less. But plus moving costs, and other expenses like furniture and painting and the upfront costs that come with buying a home. And like I said, to be ready for the unexpected. When you're a homeowner, you got repairs, you've got, potentially upgrades. There's always something that could happen. But you also need to be prepared for not only, an accident in the house happening and it causes you to have to outlay some money, but also, what if you lose your job or you have a job reduction for a couple of months? You need to have that emergency fund ready to go for those things. And it's a matter also of getting pre-approved, but also remembering that it's the payment here that matters the most. It's not the price of the home. If you're using a mortgage, it's not the price of the home in terms of what you can afford or even the interest rate, it's the payment. And the mortgage gets cheaper. That payment will feel cheaper over time. And it's one of the only costs throughout your life that you will have that's fixed over that 30 years that you presumably have your mortgage. Plus, if rates come down, you can always refinance.
How can prospective home buyers and sellers prepare for varying potential market conditions and outcomes like the rising and falling of home prices, supply, changing interest rates? Do you recommend that they just continue to save as they were before?
Well, yes, I think that the first step is to make your plan. Be ready to move quickly if rates drop. Start, for example, if you're a retiree and you're thinking about your downsizing, you might need to start that clean out process now. I think that's one of the harder things that a lot of retirees and our clients will face is just, I've been in a house for 30 years. I have all this stuff that I've accumulated through the decades. What do I do with it? Start going through it, deciding what you're going to do. Maybe start fixing up and repairing things are going to have to be done. Start talking to a realtor, a real estate agent. Get an idea on the pricing. Get an idea or understanding of your local market, and be ready to list when the time is right. But keep the big picture in sight. You've got to consider if buying that home, or maybe it's a second home, is it going to negatively impact your other long-term goals, including saving for retirement? Other goals that you might have, it might be paying for your kids' college or building that emergency fund. Make sure that all of your other financial goals can remain intact, even if you're going to take the leap and make this move into a new home or a second home. And make sure that you're setting your budget and you're sticking to it. Only buy what you really can reasonably afford, even if your circumstances change in the future. If you're a retiree, like I've mentioned before, your expenses might go down when you're not, or your income rather will go down if you're not working. For the most part, make sure that you're anticipating those changes and maybe expenses going up for things like insurance, health insurance, homeowners insurance, depending on where you are. Locality can make a big difference. So be prepared for all of those potential changes to your income and expense. And when the time comes, negotiate. It's easy to get caught up in the emotion of maybe you're in a price war with someone, but make sure you stick to your guns and don't bust your budget.
Yeah, well, it's a great point that you make, Isabel. And another thing to consider too, as home values go up because the market's not moving, assessments, to your point earlier, the insurance on your home can go up. And in some cases, it could be a few $100 a month. And that can make a big dent if you're not planning or having, a little bit extra in your budget, because once those assessments and insurance are applied, your mortgage payment, it changes within like a month or two.
Absolutely. And I don't know about you, but every single year when I get my assessment, my mortgage cost goes up because I'm escrowing for my insurance, I'm escrowing for my taxes. So, even though your mortgage and that, that payment, that principal and interest payment might be fixed, the other components can go up. And there are some areas in this country where, again, like I said, if you're a retiree and you're going from one state to the next, your health insurance costs might change. Your car insurance costs might change. They might be higher depending on where you are. So make sure you're looking at all that and taking it into account.
All right, Isabel, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me, Jill.